Hello, dear friends. My name is Clive Thompson, and I'm here to give you a lesson about investing in the stock market and different ways to do it. And this lesson is very, very special because it's about a particular way of investing in the stock market to make a lot of profit with almost no risk. Now, this is not an overnight profit. You're going to have to be in there for maybe 6 months or a year or 2 years, maybe even 3 years. But I'm going to show you a special technique involving investment companies. So first of all, I'd like to stress that everything I say today is not investment advice. It's not investment advice for you. I don't know anything about you. I don't know your situation. I don't know your wealth. I don't know your income. I don't know your age. And I don't know your tolerance for risk. So this is not about investment advice. It's about techniques you could use that you could discover investments yourself which might meet your risk tolerance, which might meet your circumstances. Now, the advice I'm giving today is completely timeless. You can watch it today, tomorrow, next week, next month, next year. This advice will be good for years and years, as it has been in the past, and you'll find many opportunities in the future to use this advice if you're willing to spend just a little bit of time, and you don't have to spend anywhere near as much time as I used to spend, which sometimes took days or weeks, because now we have some wonderful tools where you can ask ChatGPT or another artificial intelligence agent to do the sort of work which used to take me a very, very long time in the past, and you can get the answer in just a few minutes or sometimes even a few seconds. Today I'm going to show you several examples of how this has worked for me in reality in the past. So you'll see real examples, but you may say, why am I watching old stories which aren't relevant today? Well, we'll get to today later, but the old stories, each and every one has got its own technique and own special thing you can learn, special things you'll learn. So you'll learn the kinds of things I've done, and that means that's the kinds of things that you can do to uncover these valuable investments. So what's the point of showing you all these old techniques? It's so that you can learn from each and every one of them, and then I'll come on to some real live examples of companies I'm looking at today. Because the companies I'm looking at today are rather small companies, they're 100 plus million, I don't want to be seen as pushing stocks. I won't actually name them, but if you're smart and you're minded to go and use the techniques I'm describing, you'll be able to find those companies and invest in them if you choose to do so and make some money in all probability. No guarantees. It's not investment advice, but I think the odds are heavily stacked in your favor. So we'll start by looking at an example where I really made a lot of money, and I'm still in this share many years later. But I'll show you how that one works. So the first one goes back to the global financial crisis. We're talking about 2009 here. The global financial crisis started in 2008. Now, in 2008, 2009, if you were around, you'll remember there were things which became dirty words when it came to investing. Any company which had debt was bad news, because debts were being called in, so it seemed. Any company which had illiquid investments was bad news. And small companies were bad news. So broadly speaking, there was a lot of bad news, a lot of reasons not to invest. Stocks were down, and companies which did strange things involving private equity or dodgy debt or anything like that, or foreign country were investing in overseas, their share prices were all decimated. So given that any company which had debt was perceived in a negative light, I decided to go looking for companies which had no debt. And I found quite a lot of companies, but what was very interesting, I found 6 different companies with zero debt who had almost as much cash on the balance sheet as their entire market capitalization, and they had a business or other assets behind it. Give you one example. It's called Framlington Private Equity. It was a company which invested in private equity limited partnerships, and their market cap was literally the same as the cash they got on the balance sheet, give or take. And they had all these private equity investments behind them. People said, when I told them about this, they said, "You're mad, Clive. They're going to take that cash they've got and throw it into other private equity investments. We all know private equity is completely worthless these days because the stock market's collapsed." And I said, well, that might be true, but I guess the directors of Framlington Private Equity are pretty smart cookies, and if they're adding money to the limited partnerships to which they've already committed, I'm sure. Those limited partnerships will only be putting money into other companies at bargain basement prices if they really think they're going to survive. So I don't think it's that bad a deal. So I think the cash which they've got, even if it's deployed, will be put to good work. But that was one example. But I want to show you an even more special example. By the way, I've had 6 companies like that. But here's one of them, which I'm going to show you now. The company is called, these days it's called Tetragon Financial Group Limited. I think it might have just been called Tetragon Limited back then. But here's their monthly update from June 2009. Here we are, June 2009. And it says estimated value of the investments, 565 million. That's investments. On top of that, they have cash of 123 million. So the total net worth is 693 million. So they've got 123 million in cash. How many shares are outstanding? 129 million shares. What that means is with 123 million of cash and 129 million shares outstanding, it means they've got nearly $1 in $1 in cash for every share outstanding. What are their liabilities? None. All they've got is other assets of 4 million. They've got 0 liabilities. So remember this, they've got about $1 of cash for every share outstanding, plus they've got $5 of other investments for every share outstanding. So my question would be, what about this 565? What on earth is that? Well, I can tell you the answer. What Tetragon did back then, it would lend money to companies around the world, actually companies in America, broadly speaking, who wanted to borrow money from a bank. So let's say a company like Hospital Corporation of America would go to their bank and say, we need to borrow 20 million, will you lend it to us? And their bank would say, well, we'll only lend you 15 million, but to get the other 5, you've got to borrow from someone else and have that borrowing from someone else subordinated to us, so that if you get into trouble, we get paid first. And that meant that Tetragon would do the subordinated part, the 5 million at the end, the tail end of the loan, but they could charge very high rates of interest. Rates of interest like 12 or 15 or 20% even for that tail end loan, because it was a riskier loan, it was subordinated to the main loan to the bank, from the bank. So that's what Tetragon did, and that's what this 565 million is worth. So I thought, well, let's go and have a look, see how risky that 565 million is. And I go to the next page and I see down here a list of all the companies they've lent money to. As you can see, many of these companies, the biggest loan is less than 1%. Community Health, Hospital Corporation, TXU, Georgia Pacific, some fairly well-known names if you follow the stock market, but less than 1% lent to any one company. So they're very diversified. That's my first point. But then I go and look up here. This is the 565 million we see. But I see the book cost of this investment is 1 billion. So they've written down it says it's the fair value. They've written it down because we're in a credit crunch, and anything which is not credit grade, i.e. not AA at least, the value was deemed at the time to be much less. So they've taken that billion of investments in loans that you see down here and written the value down, written the value down to nearly half price. So it's actually a billion of assets which might be worth a lot less. But remember I said they've got $1 of cash per share and no debt. How much is the share price? Well, let's go and have a look at the share price in July 2009. Remember, we're looking at the statement there. This was June 2009, okay? And now we're going to look at the share price in the month which followed, which is July 2009. And you can see the share price was less than $1. So I could buy $1 of cash inside a company for less than $1, and I would get assets which had been written down to $5, let's call it, which were really worth, at book cost, $10 and might get written up. It seemed like a bargain of a lifetime. So what I'm looking for, and what I'm looking for here, is a catalyst as to why that value will be unlocked at some point in time. And the catalyst that I decided was coming was the credit crunch was going to come to an end because the governments of the world were throwing money at the banks to save them, and it was only a question of time in my mind that this credit crunch would come to an end and people wouldn't panic so much about companies with dodgy debt, or that was the assets they owned. And let's just see how that would have worked out. It did. By the way, I still own the shares. I bought them at $1, give or take, and I still own some of them today, but I've sold many of them along the way. But you can see, shortly after 2009, the share price went up very rapidly to 169, but I've still got some left today. And look where it is now today, $19. Oh, and there's a small thing I forgot to mention. Back in 2009, they were paying a quarterly dividend of 3 cents. So 3 cents a quarter, that's 12 cents a year. That meant the dividend was equivalent to 12% a year in 2009. They're paying 12 cents every year. Now, I can tell you, they have never since reduced the dividend. They've increased it, nothing but increased it, or kept it the same. And that 500 million that we saw here as fair value, there it is, was gradually written back upwards towards the billion. Why? Because they didn't actually have any defaults. So in reality, for $1, I was buying $11 of assets, give or take, inside a company, of which $1 at least was in, give or take, was in cash. So that worked out really well for me. The shares that I've still got left are now worth 19 times what I paid for them. Unfortunately for me, I sold many of them over the years as the price went higher and higher. I took the cash off the table. Oh yes, and how much are they paying as a dividend now? Remember, they were paying 3 cents a quarter. Never reduced the dividend since. They're now paying 11 cents a quarter. So that's one example of finding an investment company with a catalyst which will cause the gap between the net asset value and the share price to close. But we're going to look at another one that I found. This company is called, we're looking at, is called Sofina. And we're looking, if I go back here, sorry, oops, there we are. Sofina SA in Belgium. It's a Belgian company. The one we just looked at, Tetragon, is quoted in the Netherlands. Now we're looking at Sofina SA in Belgium, still quoted, of course. But we're looking at 2014 and 2013 and comparing the net asset value, which is here, it's shown here, it's 138 euros and 2 cents. That's the net asset value as at the 31st of December 2014. And just to let you know, the share price at that time was about 98, 99, you can see it here, about 99 euros. So share price, 99 euros, net asset value, 138. So the shares were worth 38, 39, 40% more than the book value. The net asset value was worth 30, 40% more than the share price. So what am I looking for some reason to close it? So I thought I'd go and have a look at the companies inside Sofina. Don't forget, Sofina, like all these companies I'm going to show you, they're all investment companies. Their sole activity is to invest in other companies. They don't have any manufacturing or are they not selling anything. They're not buying and selling stuff. They're not manufacturing, not trading. All they're doing is investing in other companies as investors. So what are they invested in? I go and look at this and I find a whole bunch of unquoted companies and some quoted companies. You might know a few of the names like Eurozeo or Danone and Suez Environment. Some of the names are quite well known. And they've got the amount that they held in each company. But as I went through these companies, one in particular caught my attention. It's the company here called Flipkart. And as far as I could tell, Sofina SA owned or had invested $20 million into Flipkart. So Flipkart was like the Amazon of India. That's the nearest equivalent. So I thought, well, I wonder what Flipkart is really worth. Is their holding in Flipkart really worth 20 million? I think they had 2%. Actually, it says that there 2.15% of Flipkart they had. And that was worth 20 million. But what was Flipkart worth? Well, I did my maths and I came to the conclusion, looking at comparables, Amazon was a good comparable to look at, that Flipkart probably was worth $11 billion. Therefore, 2.15% would be worth 200 million plus 220 million, 240 million, not the 20 million they had on their books. In other words, we had a nearly 200 million surplus in that company alone. So then the question is, how much is the market capitalization of Sofina, and would that 200 million make a difference? Well, the market capitalization of Sofina at the time was around 3 billion euros. So if you add 200 million, 220 million, it's adding about 7 or 8% to the value, which means that discount from 99 euros to 138 wouldn't be 99 to 138. We're going to be adding about 10 euros. That would be 99 to 148. So nearly a 50% discount or 50% upside if that gap would close. So my question is, what would make the gap close? I'm looking for the catalyst, and I'd actually found it already as I was looking at Flipkart, because Flipkart had expressed an interest in a year or two going public, and that means when they go public, the value would be realized if indeed my guess at 11 billion was right. Well, as far as I know, Flipkart never actually went public, but I didn't have to wait very long, because within a couple of years, I think it was 2018, here we are, yes, May 2018, Walmart bought 77% of Flipkart for $16 billion. You see it there. Which meant that Sofina's stake was worth a hell of a lot more than the 20 million, more than the 220 million I had calculated. It was probably worth nearer $350 million. And what happened to the value of Sofina's shares? Well, let's have a look. So here we are down in 2014 when I spotted this, that they were around 100 euros there. And as we went through to 2018, when this news came out about Flipkart, they'd gone from below 100 euros to above 150 euros, which you see there. And today, just for your information, it's 258 euros. But that was a nice, easy 50% profit in 3 or 4 years, based on understanding that there was a big difference between the net asset value and the market price. In other words, the market price of the shares was way below the net asset value, and there was a catalyst which might come, which didn't come in fact, but it happened in a different way, that Walmart bought most of Flipkart. That gave me the upside. Now let's walk forward and look at another situation. Now, this one I posted on, to let everybody know, on LinkedIn. I was kind of at the beginning of my posting on LinkedIn. I only became a member of LinkedIn about 2.5 years ago. And one of the early posts was about something called the Grayscale Bitcoin Trust, GBTC, as the symbol was known. Now, the funny thing was, this was long before the ETFs in Bitcoin. The funny thing was, and everybody who knew anything about the stock market knew this, the Grayscale Bitcoin Investment Trust was trading well below the value of the Bitcoin. And there was always this discussion going on for years and years as to whether that valuation gap would close. The gap originally was about 30 or 40%. It was huge. In other words, every share of GBTC that you would buy you 140% more Bitcoin than the shares were that you're paying for the, or pay 40% more than you were paying for the shares. In other words, every dollar was buying you $1.40. But there was no catalyst to close the gap, because people said that gap's going to stay forever. It's, the Grayscale will always trade at a discount to the net asset value, which is completely the opposite of MicroStrategy today, which trades at a huge premium above the net asset value of the Bitcoin. But go back to Grayscale. Grayscale's trading, the shares are trading below what they are worth, a lot below what they're worth. They're about 30 or 40%. But Grayscale had expressed an interest in becoming an exchange-traded fund. They'd publicly said, we want to become an exchange-traded fund, and they'd had multiple applications to the SEC to become an exchange-traded fund, and every time the SEC turned them down and said, no, you can't become an exchange-traded fund. We don't want any Bitcoin exchange-traded funds in our country, not good, too dangerous, whatever. And so every time this happened, the SEC would turn down their application. The share price, that discount would just stay there and linger. There was no reason to buy it because it seemed like the SEC would never allow Grayscale to become an exchange-traded fund. Now, the advantage of becoming an exchange-traded fund for shareholders in Grayscale, in Bitcoin Investment Trust, was that exchange-traded funds always trade at net asset value. In other words, there's arbitrageurs who are allowed to step in and deliver Bitcoin or remove Bitcoin to bring the share price upwards to the net asset value. That's what would happen if they became an ETF. But the SEC said no. So Grayscale took the SEC to court and demanded a court decision. And basically, on or around the I think it was the 18th of August, I may have got the date slightly wrong, 2023, they won the court case. There we are. It was on the 28th of August or 29th of August, they won the court case where the court said to the SEC, you cannot refuse Grayscale turning into an ETF. What that meant was that at some point in the future, after they'd gone through the approval process now, which couldn't be refused, it meant that at some point in the future, that gap of 30% was going to close. Now, obviously on that news, the gap already started to close. So on the 28th or 29th of August 2023, the net asset value was now $25, but the share price had risen from about $10 down here, or even below that at one point, it was about $6 or $7. It risen from 10 to 20. So the share price was $20, net asset value was $25. The difference between the two is 25%. In other words, there was 25% to be uplift to come as and when Grayscale would become an ETF, and there was no way the SEC could refuse it anymore because the court had ruled that the SEC was not allowed to do so. So I knew, and everybody who could read knew, that it was only a question of time before GBTC, Grayscale Bitcoin Trust, became an ETF, and that gap would close. How long did you have to wait? Only 4.5 months for your uplift of 25% of the share price going to net asset value. Now, in reality, at the same time as this was happening, the Bitcoin price was rising because people said, oh, if it's going to be an ETF, people will buy people will put it in their pension plans, they'll be able to buy it in their 401ks, they'll be able to invest in Bitcoin, because previously GBTC was restricted to qualified or specialist investors. The man in the street couldn't buy it. Well, you could upgrade, if you upgraded yourself, if you had sufficient expertise, you were allowed to buy it. But if you're a not very sophisticated person, you wouldn't be allowed to buy it. Just as today, many investments you can't buy unless you're a sophisticated investor. In other words, you've got the right sort of experience. But people like me had the right sort of experience, and plenty of people do. So those in the know, and I published this on LinkedIn for everybody to know, so nobody could say, who read my LinkedIn, and unfortunately there weren't a lot, could say they didn't know. Everyone could know that there was going to be a massive uplift in the share price as and when the ETF came, and the timescale to get that ETF was just 4.5 months, from end of August, we'll call it early September, through to January. So in January 2024, just 4.5 months later, the ETF was launched, the gap had closed, but meanwhile the Bitcoin price had been going up as well. So although those who traded like this were able to exit net asset value, the net asset value on that date when the ETF started trading was $38. So you'd have gone from $20 to $38, which is a 90% uplift in just 4.5 months. And what you didn't know is how long it would have taken to get the approval. So 4.5 months is what it actually took. It might have come quicker, it might have taken longer. But long and short of it, in a very short order, you could have known that there was a lot of profit on the table. I guess a lot of people didn't believe it, that's why they didn't buy it. But obviously, shortly after this court case, you can see the price did start rising, partly because people were saying, well, I eventually become an ETF, the gap will close, but also partly because the Bitcoin price was rising. Now, obviously, I'm saying perhaps if you sold it on the day it became an ETF, that was, whoops, there we are. If you sold on that day, perhaps that was a nice profit of 90%. In reality, it would have been much better to hang on and wait for the much higher profit today, because that share price now is over $90, 92, effectively $92, as near as makes no difference. Probably a bit more than that, because I took this picture a few days ago and the Bitcoin price has gone up by quite a few thousand since then. But let's just have a look at what I wrote about the future Bitcoin price here. So at the time, we had a Bitcoin price of, I think I must have mentioned it in the post, 27,500. And the GBTC price, as I wrote, was $20.05. I wrote it down there. And I predicted that if the Bitcoin price stayed where it was, the price should be $25.01. But I also projected what would happen if the Bitcoin price goes to $100,000. Remarkably, it's gone above that now. And I said the share price should be roughly $91, and we're above $100,000, and the share price today is above $91. So I hit the nail on the head with the forecast of the different prices. But anyone could have, if this was widely disseminated, this news about GBTC, you could have done it. But once again, I repeat, you're finding an asset trading below, a share trading below its net asset value, and you discover a reason why the NAV gap will close. But here's another one. I posted a video on it 3 months ago on LinkedIn, not on LinkedIn, on YouTube. So some of you might have watched this YouTube video. It was, the title of the video was called "This $150 Billion AI Company You've Never Heard of is Growing and Dirt Cheap. This is why I own it." Now, if you can go back and watch this video if you want, but long and short of it was, it was a company who's standing at a huge discount. Why they're at such a big discount? Because their biggest investment is a company called Tencent. And here, someone's written in the comments, for those who don't have time to speak, the company is Prosus, that's the name of the Prosus NV in the Netherlands, which owns a big stake in Tencent. So that's the reason for the discount. People said, we don't want to own shares in an investment company which has got a huge stake, almost 70% of it, is in one company, Tencent. It's too risky. We could just go and buy Tencent directly. So for some reason, these shares were trading at a huge discount, something at 50 or 60% discount, really, really large. But I could see something that anyone could have seen if you look carefully. Every single day, Prosus was selling 500,000 shares of Tencent through the Hong Kong Stock Exchange. And guess what? Every single day, Tencent was buying 500,000 shares through the Hong Kong Stock Exchange. So putting two and two together, Prosus is unloading the shares gently, probably not in collusion with Tencent. And Tencent is saying, we don't want our share price to go down. We've got lots of cash. So they're buying the shares that Prosus is selling. Now, of course, those of you who are in the know that if a company buys its own shares, you now have less shares but the same earnings per share, which is really great for the investors, because it means it makes the earnings per share rise for those who haven't sold their shares, because there's less shares to share that profit with. So good for Tencent, but also, this was the real point, good for Prosus, because that big stake in Tencent, which was holding back the share price from approaching the net asset value, was gradually being reduced. So the more they reduce it, the less there's an argument that there should be a massive discount to the net asset value. So let's just have a look at what happened to the Prosus price since then. So here we are back here where you see the line. That's when I did the video. It's 47.14 €. And I think the share price speaks for itself. It's now 61 euros. I haven't worked out how much profit that is. It's a lot. Yeah, a lot of percentage. Must be 47. That's 3 plus 10 plus 20, 24 and 47. It's 50, a good 50% profit. So you would have had 50% profit had you bought those shares, if you had believed the theory that I had got, that gap was going to close. Now, the gap isn't completely closed. There's still a long way for the share price of Prosus to approach the net asset value. But that's not the subject of this discussion, because we're going to move on to another company now, which this time I can't tell you the name. And the reason I can't tell you the name, I don't want to tell you the name, is it's a very small company. It's worth about 110 million sterling. And I don't want to be seen to be pushing a stock in which I'm currently invested. But those of you who've have been watching this video will see the skill set you need, and I'm going to describe it again just so you've got it in words of one syllable, and you can go hunting. And not only will you find the company I'm invested in here, which I'm going to show you, you'll find many other companies, or you'll find some other companies, let's say, which fit the same set of circumstances. So just for the sake of not naming the company, I've just called it UK company. And I took this section here at the top from the website of the company. So today, the share price is, as near as makes no difference, 15 pence. And the net asset value today, this is beg your pardon, at the 3rd of October, the share price is 15 pence. And at the last NAV date, which was 31st of March, the net asset value was 21.86p. So it was trading at a discount of, or would be now, if that net asset value is still true, and I think we're going to get to that in a minute, because I think it's higher than that, but the discount would be 31.52. Now, what's the catalyst to close the gap? Well, I'm reading here, and I've just cut and paste from from the website of the company concerned. I'll read it to you. During the last quarter of 2024, the board and manager carried out an extensive shareholder consultation on proposals to bring forward the company's continuation vote and change to the investment objective and policy. These proposals received strong support from shareholders at the general meeting on the 27th of February 25, and resulted in the following amended objective. And this is the important bit. What's the objective of the company? The company's investment objective is to undertake a managed wind down of the company and realize existing assets of the company's portfolio in an orderly manner. So they're going to sell everything, and then the assets of the company will be realized in an orderly manner with a view to achieving a balance between returning cash to shareholders in a timely manner and maximizing value. So when this news came out in about February that they were going to liquidate, and I could see this huge gap, I bought some shares back then, and they did indeed have the first offer to shareholders to buy back the shares. In fact, they made an offer to buy back the shares at net asset value. So the offer they made was to buy the shares, and I'm just going to click here. They made a tender offer to buy back shares at 21.119983 pence, and the shares were at the time were maybe 14 or 15 pence. So what did I do? I tendered 100% of my shares, because they only cost me 14p or 15p, to try and get 21.11 pence. And lots of other people did as well. About 61% of the shareholders tendered their shares to get the higher price. About 30% of the shareholders did not. That meant no shareholder could get all the shares repaid at 21 pence, but 2/3 of my shareholding, which I'd bought at 14, was repaid at 21, and I now had a smaller shareholding, 1/3 of what's left, still worth 14 or 15 pence. So what did I do? Well, I just sold some shares at 21p, bought some more back at 14 or 15p I think it was. So when they've got more cash by selling more investments, they'll do the same thing. I mean, that's the planned way of exiting, to keep tendering to buy shares. So the beauty of this is not everybody tenders their shares to get the net asset value, because people don't read the circulars or forget or too busy or whatever. So you get more than your fair share by tendering the shares when they make these offers. Now, they won't make any more offers to buy back the shares until they have sold some assets. But I'd just like to come back to the proposal to sell assets. So we saw here that they've decided to sell assets in an orderly manner. And I'm just reading here how they're going to do that. They're going to maximize exit value. They're going to focus on maintaining or increasing the value of the portfolio. Increasing the value of the portfolio, that's good. And avoiding, where possible, quick value destructive exit options, e.g. heavily discounted portfolio secondaries. So they're going to support, not force, exit events. They're going to focus on exits that align with planned company events, e.g. trade sales or IPOs. And coming back to this is an extract from something I read on the website of the company. So the first part that you read up the top is the chairman talking about the fact that some shares had already been tendered at 21 pence. And after completion of the tender offer, the company has 635 million shares in issue with no ordinary shares held in treasury. Therefore, the number of voting rights is 635 million. Now, here's a little bit of warning for everybody. If you do find this company, and you might find companies similar to it, because this isn't the only company where this sort of thing will be happening. I'll read it to you because it is important, and it's a risk warning about you might lose all your money or you might not get back what you put in, but I'll read it because it's important. Following conclusion of the company's first tender offer, I would like to remind shareholders that during the managed wind down, the size and value of the company's portfolio will be reduced as investments are realized, so it become a smaller company, and concentrated in fewer holdings. This may increase the volatility of the company's net asset value as it is exposed to a portfolio with low or lower diversification. Further, the company might experience increased volatility in the price of its shares. Go back to here. Where was I? In the price of its shares as a result of a possible change to the structure of the company's portfolio during the managed wind down. Once a significant portion of the company's assets has been realized, the board will then consider proposing a resolution for formal winding up and liquidation of the company. So this company, over the next year or two, and we don't know the timescale because they're going to do it in an orderly manner, will sell their underlying investments. So my next question is, what are the underlying investments? Are they diversified? What's in them? So I go to have a look. And this is the underlying investments after they've just had that buyback. They bought back their own shares. And I see a whole bunch of investments. The first one is Atom Bank. The second one is Revolut. Revolut's a UK card company. It's a payment service company. They've got tens, maybe hundreds of millions of users in the UK. Go back to that. Where was that? There we are. So I'm wondering, these investments, let's look at these investments. So Atom Bank represents 13% of their portfolio, and Revolut represents 8% of the portfolio. And I'll only concentrate on the two biggest ones because it takes time to go through every single one. So the question I've got is, Atom Bank worth more than it was worth at 31st December. So at 31st December last year, they valued it at 23 million. And at 30th of June, they valued it at 23 million, no change. Could it be worth more or less. So that valuation, 23 million, will have been derived in the past. I don't know how far back in the past. I haven't gone back to look at that. It will have been derived in the past based on various factors, maybe based on what they paid for it, maybe not. But what about Atom Bank? Is it getting better or worse? Let's have a look. So I go to the website of Atom Bank and I see this. So this is from the annual report accounts dated 31st of March 2025, which will probably have come out after that 30th of June net asset value list of investments that you just saw. So this list of investments that are held by this particular UK company, investment company, are at the 30th of June. We see it up here, over here. And this is the annual report, or a section of the annual report, up to 31st of March 2025, which would have probably come out some month later, maybe after the 30th of June, but certainly they hadn't revalued Atom Bank as of the 30th of June. But as of the first quarter of 2025, we see that Atom Bank, which is one of their investments, seems to be doing all right. We see positive growth across the board there. But the real question is, what about the profit and loss, which there's not? So I'll go to look at the profit and loss of Atom Bank, and here it is. We've got all the figures, but going down to the absolute bottom line on this, we can see down here on the right-hand side at the bottom, the profit has gone from 12.3 million, that is, in the year to March 2024, to 16.9 million in the year to March 2025. In other words, the profit in the last 12 months has risen by 37%. That's the profit of Atom Bank. So the question is, can I rely on this 23 million valuation as being correct? Well, we don't know that. It might be too high or too low, but at least the profits of Atom Bank are going in the right direction. So could well be that this 23 million is understating the value, which would mean that the shares in this particular investment company might be have a net asset value slightly higher than is shown here. Maybe it's half a p higher, maybe it's a pence or 2 pence higher, I don't know, because of that one alone. What about this second company, this Revolut company, UK payment provider? What's going on with that? So I looked into that and saw this. I got this from ChatGPT, by the way. I asked, this is the fast way to get answers to anything. You go to one of the artificial intelligence agents and you get some answers. So in 2021, Revolut raised some money and it was valued at that time at 33 billion. In 2024, some of the employees sold shares to institutions at a price which valued the company at 45 billion. That's down here in the left-hand corner. That's 2024, 45 billion. 2025, in September, just this month gone, a few days ago probably, in September, employees sold some of their shares to institutions based on a valuation of 75 billion. Now, to put that in perspective, that is 67% more than the 2024 employee sale. 67% more. And it was done in September, which means that this June valuation here of the company, the investment company, which showed a value of their Revolut shares, in fact, they seem to have reduced it slightly. Probably there are sufficient grounds to increase that value to be in line with the latest valuation as of September 2025. And that would be 67% higher if they did it like that, assuming that this 14,000 valuation is reflecting the, assuming that number was, there we are, we'll go back to that, assuming that number is reflecting the fair value based on the last share sale by the employees of Revolut. So here you see huge rights. So I'm starting to get the feeling that this investment company I found might be worth more than the previously quoted net asset value. If you remember, we had the net asset value. That's from today's website. They say as of today it was 21.86, and that 21.86 is the same. That's the 31st of March NAV. 31st of March NAV, okay? It looks to me like both at the two biggest shareholdings, Atom Bank, which has come out with results after that date, and Revolut, which has come out with results after that, or with a sale after that, looks to me like they could both be worth more. In other words, that 21.86 might be 22 or 28. Maybe it's 29 pence. If it's 29 pence, or let's say 30 pence, I mean, who knows? I don't think it's that much, but you never know. If it's higher, it means the discount, the uplift to be had, could be higher than 31%. So how long have I got to wait to get that 31%? If indeed all these values do hold up? Well, that's anybody's guess. It could be a year, could be 2 years, could be 3 years, but they've, the objective of the company is now to sell the investments in an orderly way, and as and when they sell the investments, they're going to do these tender offers where you can tender your shares at net asset value. So you bought them at 4.15p, you're tendering them at 21 or 22, whatever the price or the NAV will be, and you'll get a lot of your money back as and when they sell different investments. Of course, you'll be left with some shares because as they sell these assets, it'll become there'll be a smaller and smaller share capital, and it'll become less and less liquid, which will mean it's harder and harder for you to sell the shares without a bid-ask spread in the stock market. But probably, if they have a big sale, you might get most of what you've invested back very quickly. So do I have to wait 3 years to get it all back? I guess probably I'll get what I've invested back within, I'm going to say, within 2 years, probably less, but no guarantees. And lastly, I'm going to look at one more company. I won't go into the name of the company here. I've just put UK Property Investment Company. You can find this one if you look for it. Again, I don't want to say the name because it's a small company. It's about just over £100 million. And by the way, I have an order to buy some shares, so I don't want to sort of be pushing a stock in which I may be interested in it. It's a limited order, by the way, so it may never go through. But this company has also, if you read this, and this is from the latest report of the company, following a thorough review of options for maximising shareholder value and having engaged with, that's the name of the company, PLC's shareholders and advisors, the board of the company, PLC, announced its proposal to shareholders that the company, PLC, adopts a managed wind down and portfolio realisation strategy. So there's your catalyst. That net asset value is going to turn into cash as they sell the underlying investments. What are the underlying investments? They're properties, lots of them, hundreds and hundreds of properties. So it might take 2 or 3 years, I don't know, but they're going to sell those properties, and hopefully they will get the supposed book value. I'll come to the book value versus NAV at the moment, or the share price, but I'll just read the rest. Under the proposed managed realisation and wind down process, the company will be managed with the intention of realising all the existing assets in its portfolio in an orderly manner and with a view to repaying borrowings and making timely returns of capital to shareholders. And then they say there's a circular has been published and sent to the shareholders. That circular has gone out, and I don't think it's been voted on yet, the purpose of which is to propose a new investment objective, basically to liquidate, and a new investment policy in order to implement this managed realisation. So in my mind, there's no doubt the shareholders, if they haven't already voted for it, they're going to vote for it. And that's your catalyst. So you've got a huge discount at the moment to NAV, and that discount's going to be realised. I said I'd tell you about the discount. Currently, the share price is 59 pence, and the net asset value, according to the company on their website, as of 30th of September, it's not very clear here, but it's 76 pence is what they're putting their net asset value at. So 59 pence to 76 pence would be a 28% uplift, probably over a space of 2 or 3 years. But you might say that's not enough to hold on to the shares for 2 or 3 years. But in addition, there's something which I forgot to mention. They have a fairly hefty dividend yield. I haven't got it in my head. I think it's about 5.5%. So why are they getting that dividend yield? Because they got lots of rent coming in. This is a real estate investment trust, if you like. The rents are coming in and they're paying that out as dividends. So there's about 5%. So on top of the closing the gap, we're going to collect the rents for the next year and a half until they've sold all the properties or the portfolio's properties. So the plan is probably to sell the properties in portfolios. I haven't seen any more details on that, but that's another company where the technique is to do this. Now, I'll repeat it for you again. You find a company where the net asset value is higher than the current share price. So you buy for 10, but the net asset value is 15, for example. And then you look to see if there's any reason why that gap would close. So you're looking for a catalyst. The catalyst is something which is going to happen, which will cause investors to look at the company in a different way. So in these two examples I found, I'm looking at the moment, they're both situations where the company is self-liquidating. It's going to return all the cash to the shareholders, or return the net asset value to the shareholders. There's no guarantee you'll make money because we're obviously subject to the market movers. The market might go up, the market might go down, but your starting point is you're buying something below what it's worth, and you have a reasonable expectation if the market goes up, you'll ride the wave up, and if the market goes down, you'll ride the wave down. So there's a reasonable chance, I would say, that you're going to not only get your money back, but make a reasonable profit on these types of companies. Now, please don't go rush out and look for these companies. There's going to be plenty more situations all around the world. Start by looking in the country where you live. To find it, you can start by going to Google, or you can go to ChatGPT, or you can go to another AI and say, find me a list of investment companies which are trading well below their net asset value. And when you have that list, and there will be a lot of them, lots and lots of companies, when you have that list, you then start to look at them one by one, or you could just simply speed it up by saying to an artificial intelligence agent, which of these companies might be liquidating, or which of these companies might have a catalyst which would change investors' view, which might reduce the discount. Or you could ask, what are the directors doing to get rid of the discount to net asset value? I mean, one of the things they could do is buy back their own shares. That's, for many companies, that's a very good investment. I know you will find companies which are investment companies and which are buying back their own shares. That's another catalyst to look at. If you find those, great idea, because it kind of puts a nice support under the company. So provided the company's got cash and it has been buying its own shares and says it will continue to buy its own shares, you can reckon that probably those shares are fairly well underwritten. And as they buy back the shares, there's fewer shares in existence, and logically the gap below net asset value should start to close, not by the net asset value going up, going down. The net asset value will rise as they buy back shares, because fewer shares but the same assets means NAV per share goes up. But secondly, because they're buying the shares, the share price creeps up, so the gap closes. So you've got this double whammy of buying into a company where the net asset value should be rising, ignoring market movements, and the share price should be rising because they're buying back their own shares. So the discount is narrowing, and so you've got this double whammy of getting a higher net asset value and a smaller discount, which should give you a nice profit. Very important to make sure that when a company's announced that it's buying back its own shares, that it does in fact have the cash to do so, or you can see a place where it's going to get the cash. So, ladies and gentlemen, those are a few ways which I think that you could make money by looking at investment companies and looking for the special situation investment companies where that net asset value, or the discount to net asset value, is going to close or reduce. If you like this and want more videos, and there will be many more videos showing you tricks on how to make money in the stock market, lots of different ways, showing you some things to avoid some problems. I'll also have some interesting videos. I've got one which will be coming up in due course about the global currency reset. It's something which I think is quite likely in the next few years. But you have to start preparing yourself many years in advance before it happens. Those who are well prepared will make money. Those who are unprepared will lose money. But you have to know what it is so you know what your options are and what you could do about it. So if you like this, give me a like. And if you'd like to see more of this, subscribe. Thank you very much, ladies and gentlemen. Bye-bye for now.